All right. Good morning, everybody. Just seen Woody Harrelson and Woody Allen in a commercial. Imagine that for AI Salesforce. Well, they're spending money on their commercials. Asia down 0.5%. US down 0.25%. They're not perfectly in line, so the algos aren't hammering it. Japan up 0.25% adds a little bit of a wink and a nod. Keep your eye on Japan for the turn, if we're going to get a turn, to get back into the green. PMI this morning, the numbers look fine. We're not out of line anywhere. Nobody's forecast is off the rails, so it shouldn't be too violent, all things considered. I think the market's got something else on its mind at this point. Auctions in the front end, you could use the IRX for that one. It's close enough. Fed speakers, just adding to the administration's cabinet, where everybody fanned out last night, hitting the news services. It's dominating the headlines. I doubt anything else on this list today will knock that off the headlines. Apple's dancing. We'll see if they can avoid this fine and how much it upsets the average Apple user afterwards, because they're really capitulating, I guess is a good way to say it. If you haven't heard yet, be careful out there this week. We're supposed to be in a heat advisory through so many states, it's hard to even keep track of them all. Just uh, just be careful out there. It's supposed to be really hot. So we got the volatility trigger and zero gamma overlapping each other. Put wall in last week's level or under last week's level. Call wall 6150. We can nearly see all of it in the screen, right? We got to really expand to see the call wall, but it's not that far away. The thing is, to get to the call wall at 6150, we would have to get above this high that we've been focused on the daily, right? 6100 is that line in the sand, and it's where we've been focused for what I've been talking about. We need a higher high or a lower low. That's just the end of it right there. Anything else in the middle here is just gyrations. We have to get out of this box. The call wall is beyond this level, 6150. So it'd be up here. But because we're at the zero gamma level, if we try to rally above 6050, they're going to sell into strength. That's what the dealers are going to do. So we can do it, but it would be smaller moves on a day-to-day basis, and we'd be fighting the market makers who are trying to remain delta neutral. Underneath 6,000, we can get into the put wall 5950. That's the low end here that we've been focused on. Since we're at zero gamma, once we get through the put wall, we would expect the dealers to change their situation, and as we fall, they would sell into it. They would sell into weakness rather than buy into weakness. But we would have to get there. The last time we get down into the 5950 level, we rejected. And then when we got near it towards the end of last week, they took a front run on it. Even in the big gap down last night, we didn't get to that 59.50 level. And it immediately came back in the other direction. Now, the concern at the time was we was just going to come up and get the gap closed and then fall back out. We didn't. We got the gap closed and actually went a little higher first. Then we fell back out. Right now, we're just looking at reciprocation in the VWAP. Think of your jigsaw. You get what you give on the other side. So what we have here on the top, we expect on the bottom, that can put us in a gyration through the morning while we look for something. In this situation, we could start to develop a bit of a megaphone, going a little higher than the previous high, a little lower than the previous low. Start to broaden this out until something finally breaks. Or we can just sit tightly wound till we get the catalyst that we're looking for and then expand like a coiled spring. We don't know what it's going to be yet, but all things equal, we are where we were Friday. So as much as the weekend and the headlines and the bobbing heads and everybody gnashing their teeth, we're nowhere. We have done absolutely nothing. And the bricks that are in the wall of worry, we've had a lot of bricks in the wall of worry. This is nothing new. So I would just, caution people to tread lightly. There's no reason to freak out. We made it to the ADR edge early, which implies that we can go to the other side by the end of the day. It's worth noting, look at where it opened, and then look at where the lines were applied, as opposed to where we closed and where the lines would have been applied. Tit for tat, right? It's tomato, tomato. When the SPX opens and SPY, it's going to get these lines from 9:30. We won't have this doubt or confusion about where the lines should have started last night, whether it was the 4 o'clock close or the 6 o'clock open. They'll just be at the 9:30 open. It's very likely they will have more value and more insight for the day than these, with this gap down that we had taken that put us above the upper ADR already. Having said that, if we just ignore the gap down and read it how we would always read it, then we got to one side early. That implies we can go to the other side by the end of the day. All we have to do is break this ADR line. That's simple enough. It's the first pivot from the open last night. So if we were running an open range with first pivot high, first pivot low, that would be our first pivot high. Break that or the ADR and it opens the other side. To get there, we just have to get through the open. Simple enough. Today's floor pivot is significantly lower than yesterday's. That's bearish. Price opened underneath it, and that's also bearish. We made it back to the weekly floor pivot, but we wasn't able to get through it. 60-32 cog line, and that's also bearish. Rejected from that, and we've fallen away. It's worth keeping track of how far we fall away, right? When you get into a resistance level and price begins to pull back, how far it pulls back matters, because it has to try to come up and test again. Now, whether it can set an equal high, fail to get an equal high, set a new high, all becomes a part of the next piece of analysis. But it starts with, hey, how far did we pull back? So we're pulling back. If this continues to fade and breaks this pullback here, then we know that it's much more unlikely that we're going to retest this high or set a new high. Same as the way we pulled back from this high, right? As opposed to, say, back here when we had set a high and we pulled back and tried to make another high, couldn't get there, sell off more. Get the idea, right? So we set the level, we've pulled back from it. What we do next matters in the context of what are we going to do with it. Any rally at this point has to get back through the floor pivot. Since we've crossed this level multiple times this morning, it has no significance as a pivot point, but that's for the daily. And right now we got to get through the weekly. As long as we're underneath the weekly pivot point, we're in a bearish market backdrop. So we have to change that. S1 59.72, R1 60.74 ish. They're not too wide enough, I suppose. And since we've already hit S1, that does put R1 on the table. If we revisit S1, it's much more likely that we're going to get to S2. We've been stacking the point of control each week in a higher and higher location. Last week, we put the point of control in really close to the value area high. That's a topping out signal that we've seen before. We're going to see it again at some point. So far this week, the point of control is up still near the value area high. We're going to look for that to shift, especially with this fade down. So far, it's pretty interesting that the greatest amount of volume lines up basically with where we closed Friday. A little bit of trader's remorse from where we opened last night, came up and got that gap closed. Still early innings. There's nothing down here other than this gap close at 5,700. It's a nice 300-point move. I'd love to get a little bite of that. So let's just do the thing already. The thing is, there's nothing saying that we're going to do that at this point, other than everybody's, tripping on the news. Even getting into that 5,700 would not necessarily be bearish by itself. We're still in a complex topping pattern. "30-minute volume profile with TPO. Point of control is not going to move anytime soon. And even when it does, at least at this point, it looks like it's going to move up before it moves down. 60-60, maybe 60-70 area, but it doesn't look like it's going to end up underneath us in any way. Which, at this point, it'd be nice to have it underneath us, but it's not really the issue. It's just not going to move anytime soon. We've crossed through this level so many times, it's not resistance. Even if we got above it, it wouldn't be support. It's just a lot of structure over our head that we've got to deal with. We had a VPOC from Friday, but we hit it. So if we had marked that level out, you see how price responded to it when it first got there. That's why we tend to mark those levels anyways. But we've got there, we've hit it, we've taken it out. To me, I don't have any reason to keep the line on there. If you was to study volume profile, the textbooks would tell you to draw that line forward into today's levels, whether it was hit or not. The same with the value area high and value area low. I've got enough pivot points. I don't need another one, right? But you do you. If you want more levels, go for it. I tend to only mark out the ones that haven't been hit yet. So we had one on for Wednesday. That was hit in Friday session. I didn't mark one for Thursday. That was a holiday. As far as I was concerned, all of this Thursday price was tied in with Friday's price. So to me, there wasn't a VPOC down here anyways. We still got one at 6092 cog line overhead. Not necessarily even a VPOC at this point. It was more of a line in the sand. The reason for that is the contract change, right? The old, the new, a lot of issues with that. So this morning, we don't got much in the way of any sort of insight from the profiles. A lot of work across the bottom, as you would expect. The TPO has the point of control down here, while the volume profile's point of control is up here. 6032 cog line. Gotta love how those things just keep coming into play over and over again. So we built out a significance on each side, but volume profile's got the TPO. If we can break back down through this 6,000 level, it's very likely the point of control matches up with the TPO here again. Then they'll be in sync. We've got this entire zone or area as a high volume node. So we got to work our way through that. Getting underneath it though, once we did, if we were able to get underneath it, 59.92 cog line on the downside, it'd be a significant ceiling that I think we'd have a hard time getting back through this week. We're below the 10-day like we talked about last week. We're just getting started here, so we need to see how much we put in down below. It's been a really decent range, but all things considered, out of this range, we didn't get much in the market. Just been holding the line, correcting. We're now 2% above the 10-week. That's still good, still healthy. We want to keep our distance above the 10-week. Worst case scenario is that we actually just go back and tag it. But even that, at this point, something we don't want to get into. But 2% from the 10-week is still good. It's healthy. It's fine. We're not overbought, overextended. It doesn't owe us any sort of mean reversion or pullback or correction or anything like that. The weekly expected move indicator is functioning again this week. We can see the new range. It's significant, to say the least. It's not a range that we would see based on some economic event, right? So when you think about CPI, PPI, non-farm payrolls, even something like FOMC, the market will oftentimes reflect that in its expected price movement. We'll expect the market to go sideways into these big events because nobody wants to load up on a bunch of risk right before a big economic data point comes out. And so we end up seeing a really narrow week projected because of that. And that's not what we have. So this isn't a big wide range because the market is saying, oh, wow, we've got some large economic uncertainties and we're worried. And then they jack the vol up. This is something else completely. It could be all the war talk and all of that being priced in from last week. because that was data that was coming in on Thursday through Friday and into the close. Either way, what this is implying is that the markets can make some big moves this week. If the indexes have a wide expected move and are projected to really run, then so is 80% of the rest of the market. So this is not the week for iron condors. While you're very likely to see elevated premiums, which will make you think they're juicy and that they're worth the risk, the expected range is much bigger than our typical expected range. And those iron condors are very likely going to get run over. Just to kind of highlight, what I just drew here is a box of the entire week from 2 weeks ago. And we can put the entire week's expected move nearly into one part of this week's expected move, the top side. If we tried to balance it here, you can see how much we didn't cover. So a lot of volatility priced into the week. Now this range is not telling us that that's how far the market will move. It's just telling us that the market is pricing in a move. Over the last 5 days, healthcare is now down more than 2.5%. We could get a little shot across the bow there. If we can get above the 50, it's a nice run to the 200. Just, be mindful that it's a down sloping 200. Even if we get there and get above it, we're not likely to see, any sort of recovery dynamics at this point. Healthcare is just still broken. Consumer discretionary over a 5-day period still in the red by 0.5%. If we're going to see that capital rotation, it would be that we would expect something better than this. Look at what we have. Not much is beyond 1%. Building materials, healthcare, and if we want to give the nod, then energy. But I mean, that's it. We need the bottom three and the top three. These ones in the middle aren't really going to help out that much. So we're not seeing a capital rotation here. And someone much smarter than me once said, if you don't get the capital rotation, you're going to get volatility, right? It's one or the other. So keep your eye on the VIX. Bitcoin is down. That is the simplest explanation of risk that you can find. If they're not willing to take risk in Bitcoin, they're not willing to take risk in anything else, right? So from a risk on standpoint with the animal spirits and the blah, 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 just keep your eye on Bitcoin. If it's weak and just doesn't have any mojo to it, the rest of the market isn't going to have any either. And it's not to say that we can't rally or get a little bump today. We can get 0-day flows, some dodge in the 10-year. The Mag 7 can carry us for a little bit, but we're not going to see anything really wow if we don't have the Bitcoin as a symbol of risk. Chips are also down. So from a Mag 7 standpoint or a hyperscaler standpoint, if we don't have the chips, we don't have Bitcoin, we got nothing. Looking at things that are up this morning, we've got energy, precious metals, gold miners, uranium. China's trying it. It's just not there yet. It needs to keep pushing the line. And it's not all of China, right? We got a little bit of China up here with the yen. KWEB's another representation. MCHI. We'd want to see emerging markets. Don't have that one. And the only one of these that are up at least 0.5% is that XXX yen. So we need more out of it. Don't want a rally day on solar and energy and uranium, building materials. So this is what's got to change. Now, on the other hand, we were looking for a capital rotation, and there's a lot of the staple features. So we could start to see a bit of a pause in the Mag 7, the hyperscalers, the big growth names, and maybe a bit of a rotation back into value. All things being equal, we got a pretty simple day at this point. Remember, we're tying Thursday's data into Friday's data, take it all as one day. This is the range that we have to get out of. Now, you can start with the range that we've already made with our own Globex. It's still a really big range. Get out of this box, get out of that box. Once you start laying out the levels like cog lines, round number 6,000 to 6050, 6100, 5950, and then these Globex high, Globex low, RTH high, low, the open, there's not much left, and it's just going to be working through the levels one at a time. It's a fairly simple day. At this point, it's going to be what's the catalyst to get us out of the box. So maybe a de-escalation. Headlines can, bump us to the upside, or an escalation in war vibes send us to the downside. If we don't get either one, likely we chop around in the middle and everybody sits around waiting for data that we don't get. What I just marked out was Friday's RTH, just the regular trading session within Friday's range. There's the midpoint to get through. It's funny how that all lines up. All right, everybody, short and sweet. It's really simple. We need the headlines to get out of the box. Everybody, be careful, be safe. I'll see y'all tomorrow.